Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Manpreet and welcome to Through the Noise. Now we're coming through several much anticipated central bank meetings. A few weeks ago we had the rate cut by the European Central Bank, and more recently of course we had the Fed and the Bank of Japan favoring leaving policy rates unchanged. And it's possible that when we get to the Bank of England in a few days they may very well follow a similar approach. Now, for markets, of course, the messaging from central banks possibly much more important than the decision itself. So, to help decipher what to make of these central banks, if you're an equity or bond investor, I'm joined today by Raymond Cheng, our Chief Investment Officer for North Asia. So, welcome, Raymond. Thanks for joining us today. Let's start with the Fed. Interesting decisions, particularly from a signaling perspective. What's your take on the macro and the investment implications from the meeting?
Thanks, Manpreet. So let me start off with an assessment of the recent U.S. macro data releases. The May U.S. headline inflation was unchanged month on month, but core inflation did cool for the second straight month to 0.2% month on month, falling short of the 0.3% forecast. Importantly, super core inflation, which is the core services ex-shelter component, contracted 0.1% month on month for the first time in more than 3 years. The data highlights that barring shelter inflation, which remains sticky, broader inflation is slowing again after a brief upturn at the start of the year. The two other sticky components of services inflation, namely medical care services and auto insurance, also slow in the month of May. The falling market rents suggest shelter inflation is likely to decline in the second half of the year, while falling new and used car prices point to further declines in auto insurance and repair costs. Also, forward-looking labor market indicators, including declining job vacancy, hiring, and quit rates, point to continued deceleration in supercore inflation. Now, as for the last FOMC meeting, Fed Chair Powell did leave interest rates unchanged. He acknowledged the 2 straight months of softer than expected inflation data, but did add that annual inflation remains too high. As a result, the Fed, in its June forecast update, reduced the median projected rate cuts for this year to just 1 cut, compared with 3 cuts anticipated back in the month of March. And they also raised the inflation estimates for this year and next. Now, given the nearly even split among the number of Fed members voting for 2 rate cuts this year, 1 rate cut this year, and no changes this year, we believe we will need a few more months of lower inflation in order to sway more members towards 1 or more rate cuts this year. Now, our interpretation of the Fed's stance is that the Fed continues to lean towards being cautious to avoid the risk of loosening financial conditions prematurely and delaying the disinflation process. We expect disinflation to continue over the ensuing months as official shelter inflation catches on with already declining market rents. Sustained disinflation could make the current U.S. monetary policy too tight, ultimately leading the Fed to start cutting rates in the second half of the year. Now, all in all, our base case remains to be the economic soft landing thesis for the U.S., wherein growth and inflation continue to moderate, which should augur well for risk assets. Now, we believe improving U.S. corporate earnings outlook, especially for the tech and communication services sectors, will likely continue driving U.S. equity outperformance to the rest of the world, especially if the Fed starts to cut rates in the second half of this year. Furthermore, our quant and technical models continue to remain upbeat on global and U.S. equities.
Thanks, Raymond. That's a comprehensive overview of the U.S. markets and the Fed decision. But what about the Bank of Japan? We had the decision today, and the Bank of England coming up soon. Particularly from a currency investor's perspective, those both could be significant.
Yeah, the BOJ did leave policy rates unchanged at the latest meeting, while stating it will set up plans to reduce the amount of bond buying at its upcoming meeting next month. However, the previous reduction in JGB purchases on May 13th did not result in any sustainable yen appreciation. What's more, the latest meeting failed to boost market expectations for further rate hikes. Therefore, we still view interest rate differentials as favorable for the yen carry trade for now, which means using the yen as a borrowing currency to buy higher yielding currencies. Now, technical resistance for the dollar yen remains at 160. Now, shifting gears to the UK, economic data continues to look mixed there, with GDP growth slowing modestly in April, while wage growth remained at a 4-month high and manufacturing PMI reached expansion territory in May. The UK retail sales growth in May also points to a resilience in consumption activity and the likelihood of sticky inflation, supporting a further delay to the start of the BOE rate cutting cycle as compared with the ECB. The markets expect the BOE to keep rates unchanged this month and cut by 25 bips in the month of November. Against this backdrop, we see the pound versus the US dollar to be range bound between 1.264 and 1.289 ahead of the BOE meeting. The outcome of the upcoming UK election will also provide some support to the pound in the coming months. Opinion polls suggest the Labour Party will likely win the election in July. A Labour Party win should lead FX markets to price in closer ties with the euro area in the medium to longer term. This likely exposes the euro versus the pound to further downside towards 0.839.
All right, shifting gears a little bit, one of the other headlines markets were paying attention to this week was the EU's announcement of tariffs on Chinese EV imports. In your view, is that something equity market investors should worry about, particularly those in China's consumer sector?
Let's go into some details, right, around the tariff. Following the U.S. announcement of the higher tariffs on Chinese EVs imports last month, the EU followed suit and now announced to impose additional tariffs on Chinese EV imports in the range of 17.4% to 38.1%. On top of its already existing 10% duties. All this are expected to come into effect on July 4th this year. Now, given the cost advantage, our view is that Chinese electric vehicle manufacturers will likely stay price competitive even with the higher tariffs in place. Therefore, we expect the impact to China's consumer discretionary sector to be contained. However, longer term, we think this event could mark a re-intensification of geopolitical tensions between China and the West. We believe China will likely retaliate against these European tariffs by imposing tariffs on cars imported from the EU. Also, the U.S. presidential election come November could also raise a further risk of disputes between the U.S. and China. Now, given China equities historically underperform the rest of global equities, we remain neutral on China within Asia ex-Japan equities.
Okay, and finally, recent data showed that China's central bank had been slowing purchase of gold for the last couple of months, which seemed to coincide with a slowdown in gold prices. What do you see as the implication for gold prices specifically?
Yeah, the PBOC indeed significantly reduced its rate of gold purchases in May this year after a gradual slowdown in purchases since the second half of last year. To share some numbers, the average monthly addition was 26 tons in the third quarter last year, which then fell to 15 tons in Q4 last year, and then further down to just 1 ton this past quarter. The PBOC in general has been a major buyer of gold as it accounts for almost half of the global net purchases over the last 18 months. Now, we have previously indicated that elevated gold prices could dampen central bank demand in the short term, slowing the pace of gold price gains. And analysis of the PBOC's past purchases basically reveals that they similarly taper off after these previous gold price gains. So, in our view, this illustrates the PBOC's price sensitivity to gold in the near term. That said, we think it's likely that the PBOC demand will likely come back. In the year of 2016, gold purchases paused for 1 month before they resumed. Also, the share of gold in China's total reserves is just around 5% for now, even with the recent round of buying. And that is significantly below the double-digit percentage allocation by major central banks into gold. Hence, we continue to expect gold prices to be range-bound in the near term with US $2,200 per ounce being a key technical support level for gold.
Okay, thanks, Raymond, so much for that very comprehensive conversation. We covered several key topics today, but we're just about out of time. If I can maybe just sum up the key takeaways from my perspective. Number one, of course, the Fed decision being consistent with a view of a soft landing and favors of continued outperformance of U.S. equities relative to global markets. Second, of course, the Bank of Japan, potentially a bit of a disappointment for the currency. So we can't rule out a test towards 160 for dollar yen in the short term. And of course, gold, 2200 being a key level for gold prices, especially for Chinese central bank buying returns as closer to those levels. So thanks so much for taking the time to listen to today's podcast. We'll bring it to a close over there, and we look forward to speaking with you again next week.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.